Before we begin, remember this is not financial advice. Always do your own research or consult a financial professional before making any investment decisions. Did you know that in 2023 alone, inflation in the US hit over 6% at one point, significantly reducing the buying power of money sitting in regular savings accounts? And did you know that Americans are sitting on over $13 trillion in low-interest savings accounts? If your money isn't working for you, it's losing value. In this video, we'll cover the most secure financial products and why they matter for protecting your hard-earned money. In today's rapidly changing economy, it's crucial to understand how to keep your money safe from inflation, market volatility, and unexpected financial disruptions. From secure savings products to government-backed investments, these options can provide stability and peace of mind. We've all experienced financial uncertainty at some point, whether it's watching the stock market dip or dealing with rising costs of living. Inflation can eat away at savings, and market volatility can make investing feel like a roller coaster. Many of us keep money in traditional savings accounts, but with interest rates often below inflation, these accounts might not protect or grow your wealth effectively. So, what are the options for those looking for security without the risk? That's where secure financial products come in, offering a solution to protect and grow your wealth with minimal risk. Let's dive into some of the safest financial products available. High-yield savings accounts, HYSA. A high-yield savings account works similarly to a regular savings account but offers much higher interest rates, often 10 to 15 times more. For example, while a traditional savings account might offer 0.01%, a high-yield account can provide rates from 3% to 5%. Popular online banks like Ally, Marcus by Goldman Sachs, and Discover offer these accounts. They are FDIC insured, meaning your money is protected up to $250,000 per account holder, per bank. This makes them a risk-free way to store emergency funds or short-term savings. Certificates of deposit, CDs. CDs are fixed-term savings products where you lock your money for a set period, from a few months to several years, in exchange for a higher interest rate. Unlike savings accounts, you can't withdraw your money before the term ends without facing penalties. A 5-year CD, for instance, may offer an interest rate of 4% or higher, which can be a secure way to build savings over time. Examples of competitive CD rates can be found at banks like Capital One, Synchrony, and PenFed. Government bonds, U.S. Treasury Bonds, T-bills, and T-notes are government-issued securities that are considered nearly risk-free because they are backed by the full faith and credit of the U.S. government. Treasury bills, T-bills, are short-term bonds that mature in less than a year, while Treasury notes, T-notes, have terms between 1 to 10 years. These bonds are highly liquid and can be purchased directly from the U.S. Treasury or through investment brokers like Fidelity or Vanguard. Treasury inflation-protected securities, TIPS, are a special type of bond that adjusts with inflation, making them an excellent hedge against rising prices. Money market accounts, MMAs. A money market account is like a hybrid between a savings account and a checking account. It offers higher interest rates than a traditional savings account and allows you to write checks and make a limited number of withdrawals per month. MMAs are typically FDIC insured, so they're another safe place to store cash. Examples of MMAs with competitive interest rates are available at institutions like UFB Direct and CIT Bank. Corporate bonds. While slightly riskier than government bonds, corporate bonds issued by established companies like Apple or Microsoft can be relatively secure, especially if they are investment grade. Companies use these bonds to raise funds, and investors are paid interest in return. The risk here is tied to the company's ability to repay, but investment-grade bonds from blue-chip companies are generally considered low risk. Depending on the company, you can earn a yield of 3–6%. So, which is the most secure financial product? U.S. Treasury bonds remain the safest bet for those seeking zero risk. These bonds are guaranteed by the U.S. government, which means your principal is secure no matter what happens in the economy. For those looking to hedge against inflation, TIPS are especially useful because they increase with inflation, offering a dual benefit of security and protection against rising prices. During times of economic uncertainty, Treasury bonds stand out as the gold standard for financial safety. To recap, if you're looking for security in your financial products, high-yield savings accounts, CDs, government bonds, and money market accounts offer solid options. For those looking for a balance between safety and inflation protection, Treasury bonds and TIPS are your best bets. These products ensure that your money is safe and working for you. What's your approach to keeping your money safe? Let me know in the comments. And don't forget to like and subscribe for more insights on financial planning. Be sure to check out my next video on advanced financial planning strategies for long-term wealth building.